Are you thinking of starting investing but unsure where to begin? In today's video, I'll be sharing some simple strategies to help you get started on your investing journey in 2020. These strategies will help you invest with confidence, improve the rate of your returns, and boost your overall knowledge about the stock market itself. What's going on, everyone? Welcome back to Financial Knowledge, where I bring weekly investing and finance related advice. If you're new here, consider subscribing. All the support is greatly appreciated. I'll leave timestamps and links to everything that I mentioned in this video can be found in the description box below. The strategies I'll be discussing in this video are relevant in 2020 and any era of stock market investing. They've stood the test of time and they've been consistently used and refined over decades by the world's greatest investors. As I go through each tip, I provide real-life examples and resources that you can refer to after watching the video. These tips are consistent, reliable, and reproducible. The advice provided will help you identify strong businesses that will make great investments and the exact information that you'll need to make informed decisions when selecting companies to put your money into. Remember, if you learn something new, make sure to hit that like button and support the channel. So right now, I'll be jumping into my top 3 tips to help you start investing in 2020 and exactly how you can grow a profitable stock portfolio as fast as possible. My first piece of advice is investing for the long term. Now, I think it can be a common misconception when you first start investing that you're only meant to hold your shares for a short period of time. And I'm talking, say, months, weeks, or even only days. But what you really should be doing is the exact opposite. You want to hold your shares for a long period of time, and I'm talking 5 years plus. This may sound like a long period of time, but in the grand scheme of things, it really isn't. 5 years is quite short, and the reason I say this amount of time is because you need to leave your investment long enough for it to grow and develop. Because when you're investing, you're essentially just looking for the strongest business that has the best long-term financial future. And if you're always dipping between different companies and not holding that company that your investment is related to, you don't give enough time for it to grow and develop. And it can be quite a poor strategy because ultimately in the short term you can lose a lot of money, but in the long term small ups and downs aren't really a thing to worry about. And if you get caught up in short-term changes, it can be quite frustrating, and that's why a long-term outlook is the most consistent and reliable method if you're trying to guarantee yourself a profit in the stock market. Let me know in the comments what investing strategies you guys use. I'd love to hear from you, and I'd really enjoy engaging with my viewers. Now, diving into my second tip, not investing emotionally. Now, this is something that's really easy to do as it's essentially human nature, but you really want to avoid it when you're making investments. Now, what I mean by investing emotionally, when they get caught up in short-term ups and downs, which are essentially just inevitable on the stock market. They might see the share price of a company rise by 20% in just a week, and they automatically start buying shares in the business. Or they might see a 20% drop in a company that they own, and they'll automatically start selling that company. But rising and falling share prices aren't the be-all, end-all of investing. There's more to it, and there's more factors that you need to consider when you're buying companies. Constantly checking the share price of a company, looking at your portfolio, seeing if you've gained or lost money can be a very stressful situation, and it's a type of investing that I'd strongly recommend against. That's why, going back to tip number 1, if you focus on the long term, it protects you from this emotional stress and protects you from this potential anxiety that can come from investing if you're always worried about losing or gaining money. Because if you're thinking in days, months, weeks, it's really not a good way to invest. And you want to be comfortable to an extent that there's a chance you're going to lose money. The third tip that I have is understanding what you own. Now, this is key because it brings confidence to your investment and it helps you understand a company. And if you understand a business, you can accurately determine if it's a good investment or not. Now, when I say understanding a business, I mean knowing finer details about it, like how it makes money, what's the management's long-term plan, what are the potential risk factors for the growth of a company. Now, as an example, I'll just describe the way that McDonald's makes its money and its business model that it has. So McDonald's is largely based on a real estate and rent factor for its business model. So McDonald's will own the land, and then a franchisee will pay McDonald's the right to bear the McDonald's name and open up a restaurant, and then the franchisee will have to pay McDonald's rent, royalties, and along with the initial commission to bear the McDonald's name and build the restaurant. So some of the potential risk factors that could affect McDonald's people's desire to buy fast food. Can the franchisee make enough money to pay the rent and royalties for McDonald's? And are people actually willing to bear the McDonald's name? Is it a strong business worth investing time and money into and building your own restaurant and being a part of that franchisee culture? If you want to find a bit more out of business, an excellent place to look is a 10K report. Now, this is a large document that outlines a lot of detailed information about a particular business, such as risk factors, management's plan for the business, its future goals, and a lot of information in regards to revenue growth and financial details. It can be quite a lengthy read and a bit of a daunting task, but the more 10K reports you look at, the easier they are to extract the key information and the more efficient you become when looking at them. Well, that wraps it up for the video. I hope you found the content useful and you can use it to start investing and making some great returns in 2020. As always, if you enjoy the content, make sure to like and subscribe, and feel free to click the links on screen, and I'll see you guys in the next video.